Hey, good morning once again, options traders. Well, why should we view volatility as the options price? This is a topic that really throws new traders because they look at the price of the option on the quote board in terms of dollars and cents. And obviously, that's important information. But to a professional trader, we want to know about the volatility component, not just the dollars and cents. We want to know how it's being priced in terms of volatility. And so you have to say, well, why does it matter where the price is coming from? I can just see that the price is whatever, $3, and I can see it's moved to 350. Well, it's a very good question. It's a fair question, but there's also a really good answer. So let's go find out why. As always, before we do, please be sure to click like and subscribe. It's always appreciated and goes a long way into promoting the channel. So to start, we have to go back to a pricing model. And I know you all have seen this before. We have five basic factors, six if we want to count dividends. But if we look at let's say a Black-Scholes pricing model, we need to know the stock price, the exercise price or the strike price, time to expiration, the risk-free interest rate, and most important of all, volatility. So why is volatility the most important driver? Well, remember, if we're all trying to value an option at a certain point in time, we would all be using the same stock price. There's no room for argument there. If we're trying to evaluate the $100 strike, we have to use 100 for the exercise price. If there's 30 days until expiration, we have no choice but to use 30 days. Risk-free rate is, for the most part, pretty much set in stone, so we don't have a lot of room there. But we could be very different in our interpretations of what the future volatility will be. And remember, that's really what the pricing model wants. Not what the volatility is right now or what it's been in the past, but what will it be over the life of the option. And of course, that's something we can't know until we get to expiration. And so that's why we usually call it implied volatility. What's the volatility that we need to use to create the current option price? And therefore, we can back into it and say, well, the market must be implying that this will be the future volatility. So this is ultimately what gives an option value. If we have very low volatility, or at least a very low outlook for future volatility, we're going to have relatively low option prices. On the other hand, if traders think there's going to be an explosion in volatility in the erratic nature of this stock's price, then you're going to see a big increase in the volatility or in the implied volatility. So this is really the whole key, is this whole idea of volatility, because it's really what drives an option's value. So also remember what volatility is. It's really just the uncertainty of stock prices. Anyone who's ever traded the market for any length of time certainly knows this idea of uncertainty or volatility. Now it's measured when we look at our broker's platform and it says the volatility is 25%. It's really, from statistics, the same concept that we call a standard deviation. It's an actual calculation. We can go in there and say, this is the volatility that the market is using to price this option. So if we have higher volatility, more uncertainty in the market, we will get higher option prices. So volatility is, again, really the true option value, and it's coming from the right to walk away. So also remember that options were created as hedging tools. And the more that you're willing to pay for the option, it's because you're looking for more insurance. In other words, if you buy a call option and the stock falls, well, it's giving you the right to walk away from the deal and say, you know what, I'm going to decide to not exercise this call, and I'm just going to take my relatively small loss. So the more uncertainty there is in the market, the more you're willing to pay for the right to walk away. So let's now go over to a pricing model and find out more of the details why professional traders prefer to see option prices in terms of volatility, not in terms of dollars and cents. All right, so now I'm over into a new pricing model. Looks like they changed the one at the OICs. This is at barchart.com. So here we have the underlying stock price. I'm going to set it to 100. Strike price is 100. Days to expiration, 60. Risk-free rate, 4%. Volatility at 20%. And we'll just make dividends 0. And with these parameters, it's telling us that the option's price, what's called the fair value or the theoretical value, is 356. Now remember what fair value means. If you were to buy hundreds of options like this, not counting commissions, or sell hundreds of options like this, not counting commissions, in the long run, you would just break even. So that's what's meant by a theoretical price. So now take a look at this. It's 356. So let's make the stock price rise $1, and we see that with the delta of about 55, we should pick up about 55 cents on this dollar move. And so we're going to move from 356 to 413. So the thing is that if you see that the options price has moved to 413, why did it move? Well, in this case, it's just because the stock went up $1. And that's not really all that interesting. We know that at 20% volatility and 60 days to expiration, the stock's price is going to move. And yes, that's going to make this options price fluctuate up and down. But that's not really what's driving the value of the option. That's really just noise. And if you focus on this number and saying, oh, the option's price went up, we have to say, but why? In this instance, it's just because the stock price went up. But you see, I could also make this go up to a price of 413. Let's set this back to 100. Let's move it from 356. How can I get it to go to 413? I can come down to what's called the implied volatility calculator, type in 413, and it tells me that we would need an implied volatility of about 23.5%. So if I make this 23.54, look at that. It also makes the options price 413. So when we see that the options price rose from 356 to 413, was it because the stock price moved? Or was it because volatility changed? Or maybe some combination? So in this case, if we see that it's because the volatility increased, that's far more important than saying that it rose to 413 just because the underlying stock rose $1. See, if we go back to 20% and we make this 101, the volatility is still 20%. The right to walk away, the true value of the right to walk away, didn't change. And so that's why when we just see that this price is at 413, yeah, it's kind of like, okay, well, so what? It's just because the stock price moved. But the real driver of the option's value didn't change. But again, if we contrast that with keeping the stock at 100 and making this 23.54, that also increases it to 413, but that is far more meaningful because now I see that option traders have increased the price of the option due to expectations of future volatility. They're willing to pay more for the right to walk away, not just because we've picked up some intrinsic value. So the main thing to understand about option prices is that volatility is the true driver of an option's value. Price changes from the underlying are simply due to noise at the current volatility. So again, that's why it's not really all that interesting. We know the option's price is going to fluctuate, but if it's fluctuating because of a change in volatility, that's where the real information is. So if you focus on volatility, or the implied volatility, you'll have a better understanding of what's driving the option's true value. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.